In the previous episodes, we built a complete financial model: growth revenue, cost of sales, operational expenses, salaries, and capital expenditure. And we reviewed the full picture on the summary dashboard. Now we are going to answer the next important question every investor and founder needs to think about. What if things don't go exactly to plan? What if revenue grows faster than expected? What if costs are higher? What if we raise more or less funding than planned? That's what the case scenarios section is built for, and it's one of the most powerful parts of the model when you are preparing to talk to investors. The case scenario sections take your scenario and the financial model you've already built and lets you explore two alternative versions of the future alongside it. A positive variance, which represents your upside or best case, and negative variance, which represents your downside or worst case. You don't have to rebuild a whole model for each version. Instead, you define a set of percentage or value adjustments on top of the base, and the model calculates everything else for you automatically. At the top of the page, you will see the scenario selector, which is set to base scenario by default. If you have multiple scenarios set up in Uniflow, for example a base, a bootstrapping, or one built for specific investors, you can switch between them and run the case scenarios analysis for any starting point. For this episode, we are working from the base scenario, which is the model we've been building throughout the series. Below the scenario selector, you'll see the scenario comparison chart. By default, the chart shows cash flow, but you can switch to the end balance or net income using the tabs at the top right to see how each scenario affects those metrics instead. The value of case scenario is not to make those numbers look better. It's to show how different decisions could change the trajectory. Now let's build the upside case in the positive variance section. Here you can set 4 types of adjustments. Each adjustment has a positive and negative input, so you can fine-tune the assumptions precisely. Let's try entering, let's say, 20% more revenue in the positive direction for change in revenue. As soon as you do that, the positive variance metrics update immediately. Total revenue jumps from 658,000 to 790,000. That's the 20% revenue uplift flowing through the forecast. Net profit improves to minus 14,450,000. And if you look back at the chart, you will see the green dashed line starting to diverge upwards from the base case, showing a visually cleared representation of what the upside trajectory looks like. Below the positive variance, you will find the negative variance section as well. This works exactly the same way, but in the opposite direction. You are modeling what happens if things are harder than expected. And to be fair, usually they are harder than expected. So it's good to be really prepared for those times. Let's enter 15% less revenue in the negative variance. The model will show what happens to the cash flow and balance and net income if your growth assumptions don't fully materialize. The red dashed line on the chart will drop further below the base, showing you the downside range, the scenario you need to plan for but hope to avoid. Together, the positive and negative lines create a range of outcomes, and that range is exactly what a well-prepared investor conversation will look like. When you sit down with an investor, they will almost always ask you, what are your assumptions and what happens if they are wrong? The case scenarios section gives you a structured, honest answer to that question. Investors find this credible and reassuring because it shows you've thought through the risk and you understand your own model. It also makes it easy to have a conversation about what level of investment changes the trajectory, because the change in funding adjustment lets you show in real time what an additional 500k or 1 million of investment would do to the cash flow or runway curves. One final feature worth highlighting: the 3 tabs at the top of the chart. You can switch the view from cash flow and balance or net income at any time. Switching between these three views during an investor conversation lets you answer different questions from the same set of assumptions without having to rebuild anything. So, to recap, the case scenario section takes your complete financial model and lets you explore the upside, the base, and the downside all in one view. You set simple percentage or value adjustment for revenue, cost, and funding, and the model instantly recalculates the metrics and charts for all three scenarios. This is one of the most investor-ready features in the whole model, and it's worth spending time on your assumptions here before any investor conversation. In the next episode, we will move into the valuation section, where we will look at how to think about what the business might be worth today and over the next 5 years, and how to connect the financial model we've built.